There is one part of your portfolio that was never supposed to scare you. The boring part. The part every advisor points to when they say, don't worry. This is the safe money. Bonds, the seatbelt, the thing that's supposed to hold you in place while stocks do the crashing. In 2022, the seatbelt was bolted to the same car that hit the wall. The safest long-term bonds on Earth, government debt, the asset entire textbooks call risk-free, had their worst year since 1754. Not 1954, 1754. The runner-up was 1803, the Napoleonic Wars. And it wasn't close. To find a year that hurt bondholders more than 2022, you have to go back to before the United States existed. And here's the part almost nobody noticed while it was happening. Two people could have owned the exact same bonds in the exact same crash and walked out of that year with completely opposite results. One lost nothing, nothing at all. The other watched tens of thousands of dollars disappear from a statement and stayed gone. Same asset, same year, same drop on paper, opposite endings. By the end of this, you'll know the one thing that decided which of those two people you'd have been. And it isn't which bond you bought. It isn't how much you had or how smart your timing was. It comes down to whether the thing you bought has a date on it. I know that sounds like a technicality, the kind of footnote you skip. It was the entire difference between one retirement that survived and one that didn't. Give me the next few minutes and I'll show you the mechanism, in dollars, step by step. Because once you see it, you can't unsee it in your own accounts. Before any of this makes sense, you need one rule. Just one. It's the whole engine of the bond market, and it fits in a single sentence. When interest rates go up, the price of bonds that already exist goes down. Every time. No exceptions. Here's why, and it takes about 20 seconds to see it for good. Say you lend the government $1,000 and they agree to pay you 3% a year. $30 every year like clockwork. A few months later, rates have risen, and the government is now selling brand new bonds paying 5%, $50 a year for the same $1,000. Now you decide you want to sell yours. Who's going to pay full price for a bond that pays $30 when they can buy a fresh one paying $50? Nobody. The only way anyone takes your old bond off your hands is if you drop the price until your $30 a year works out to the same deal as everyone else's $50. So the price of your bond falls. You didn't do anything wrong. Rates just moved, and the market repriced what you were holding. That's it. That's the rule the whole crash runs on. Rates up, bond prices down. But notice something buried in that example because it's the hinge this entire video swings on. Your bond falling in price and you actually losing money are not the same event. The price on the screen dropped, but if you simply keep the bond, it still pays you your $30 every year, and it still hands you your $1,000 back on the day it matures. The loss on the screen only becomes a loss in your life if you're forced to sell, or if you're holding something that has no maturity date to hold to. Hold onto that distinction. A falling price is a threat. Whether it becomes a wound depends entirely on one thing. Does the thing you own have a date where the money comes home? So let me introduce two men who are about to run straight into that rule and who are, on paper, the same person. Ed and Walt are both 62. Both just retired. Both did the thing you're supposed to do as retirement gets close. They moved a big slice of their money out of stocks and into the safe part. Same slice, down to the dollar. $500,000 each. Both put it into essentially the same thing, high-quality US Treasury bonds, the boring middle of the maturity range, around 7 years out. Same amount, same asset, same moment. Early 2021, when rates were still scraping along near the floor. If you lined up their two accounts side by side that January, you could not tell them apart. Same balance, same risk on paper. Two men who had both, by every conventional measure, been responsible. There is exactly one difference between them, and it's so small it sounds like paperwork. Ed bought his bonds directly. He owns the actual Treasury notes. Specific bonds with a specific maturity date printed on them, the day the government pays him his principal back. He bought them intending to hold them until that day. Walt did what almost everyone actually does because it's easier, and it's what the retirement account offers him. He bought a bond fund, a single ticker that holds thousands of bonds in one basket. He never picked an individual bond in his life. He clicked buy on the fund and closed the app, exactly the way you're supposed to. That's the whole difference. One owns bonds, the other owns a basket of bonds. It sounds like the same sentence twice. For 18 months, nothing happened to suggest it was anything more than that. And then 2022 arrived, and that tiny, boring, paperwork sounding difference split their two retirements down the middle. In 2022, the Federal Reserve did something it hadn't done at that speed in 40 years. To fight inflation, it took its benchmark rate from basically zero, a range of 0 to a quarter percent, up past 4.25% in 9 months. The yield on the 10-year Treasury, the number the whole bond market pivots around, went from about 1.5% at the end of 2021 to nearly 4% a year later. Rates didn't drift up. They shot up. Now apply the one rule from a minute ago. Rates up, bond prices down. Rates up this fast, bond prices down hard. Watch it hit both men, because at first it hits them the same way. Walt opens his statement. His $500,000 bond fund, the safe money, the seat belt, is down 13% on the year. That's not a typo, and it's not a stock fund. That's the broad US bond market having the worst year in the history of the index that tracks it, going back to 1976. 13% of Walt's safe money gone from the page. Now Ed owns the actual bonds, but a bond still has a market price, and if he looks, he sees the same horror. Those 7-year treasuries he paid full price for in 2021, repriced them at 2022's higher rates, and they're worth about 16% less. On paper, Ed's $500,000 looks even worse than Walt's fund for a moment. So here's where they stand at the bottom of 2022. Two men, same $500,000, same safe treasuries, both looking at a paper loss somewhere in the mid-teens. If you froze the tape right here and asked which one is in trouble, the honest answer is they look identical. Both got hit. Both are down. Nothing on either screen tells you they're about to walk in opposite directions, and then each of them does one thing, and the two things are almost nothing. One of them, in fact, does actually nothing. That's the moment the whole story turns. Start with Walt, because Walt's path is the one almost everyone is actually on. Walt owns a fund, and a fund has a feature that sounds trivial and turns out to be everything. It never matures. There is no date. A bond fund is a basket that's constantly selling bonds as they age out and buying new ones to replace them forever. It never arrives anywhere, which means it gets repriced every single day the market is open, and whatever the market says it's worth today is simply what it's worth. When Walt's fund fell 13%, that wasn't a scary midpoint on the way to getting his money back on some fixed date. There is no fixed date. The 13% was just the price now. $65,000 off his $500,000 sitting on the statement with nothing built into the instrument that promises to bring it back. If Walt needs to sell, he sells at the new number. The loss isn't a threat hanging over him. It's already real. Now Ed. Ed is looking at a worse number on paper. His bonds are down around 16% if he checks, but Ed doesn't check. Because Ed doesn't care. Because Ed has the one thing Walt's fund structurally cannot have: a date. His treasury notes mature in 2028, and on that day, the government doesn't pay him market price or panic price or whatever the mood is that morning. It pays him back the full face value of the bonds, every dollar of principal, exactly as promised, regardless of what happened to the price in between. So Ed does the only thing the situation asks of him. He does nothing. He keeps collecting his interest, a little over $34,000 in coupons across the life of the bonds, and he waits for the date. When 2028 comes, Ed gets his principal back. Whole. The realized loss from the worst bond year since 1754 on Ed's account? 0. Not small. 0. Sit with what actually separated these two men, because it's almost unbearably thin. It was not how much they had, same 500,000. It was not what they bought, same safe treasuries. It was not the crash, same crash, and Ed's paper drop was actually the bigger one. The survival and the wipeout happened on the same day in the same market to two men who were down the same amount on paper. One of them was holding something with a day the money comes home. The other was holding something that has no such day and never will. That single structural fact, a date or no date, is the entire distance between 0 and $65,000. Nothing announced it. No alert fired. Walt didn't do anything reckless, and Ed didn't do anything clever. The difference was baked into what each of them bought 18 months before the crash, on a detail so quiet that neither of them likely thought about it when they clicked buy. There's a fair question sitting underneath all of this. If bond prices fell across the board, why did some funds lose 13% while others got demolished? The long-dated ones that dropped almost 40%. Same rule hit all of them. Why such different damage? There's a single number that answers it, and it's printed on the fact sheet of every bond fund you've ever owned in a spot roughly nobody has ever looked. It's called duration. Duration is just a measure of how hard a bond or a bond fund reacts to interest rates. The plain English version, it's roughly how much you lose for every 1 percentage point rates rise. That's the whole thing. A fund with a duration of 6 loses about 6% when rates go up a point. A fund with a duration of 17 loses about 17. Put a real number on it. Take a retiree with the same 500,000 we've been using, sitting in a broad bond fund, the kind most people actually hold, duration around 6. Rates rise 1 point, and she's down about $30,000. Now take her neighbor, same 500,000, but in a long-dated Treasury fund with a duration of 17. Same 1-point move, same day, same rule. And he's down about 85,000. Same retiree, same money, same interest rate move. A $55,000 gap between them, and the only thing that differed was a number on a fact sheet neither of them had read. That's the difference between a bruise and a broken leg, and it was never hidden. It was disclosed in plain print the whole time, and this is exactly what produced that opening number, the worst year since 1754. The bonds that fell 39% weren't fragile because they were risky in the credit sense. The US government was never going to skip a payment. They fell that far because they had enormous duration, decades until maturity. The longer the wait for that date, the more violently the price swings on the way there. High duration is what turned a rate hike into a once-in-270-year loss. Ed's 7-year bonds had modest duration and a date close enough to hold too. The 1754 bonds had a date so far away it barely functioned as one. Now, if I stopped here, you'd walk away with a clean little moral. Individual bonds, good. Bond funds, bad. Ed, smart. Walt, foolish. And that would be its own kind of lie, the comfortable kind. So let me take the story apart from the other side, because neither of these men actually won cleanly. Start with the thing Walt's fund does that looks like a weakness and is secretly a strength. It never matures. Yes. But that also means it never stops working. As Walt's fund held those bonds through the crash, it was also constantly doing something Ed couldn't, selling off aging bonds and buying new ones at the new, higher rates. By 2023, the fund was stuffing itself with bonds paying 4 and 5% instead of 1%. That higher income doesn't erase the price drop overnight, but it steadily heals it, roughly over the span of the fund's duration, about 6 years. The fund that fell hardest is also the one being rebuilt, from the inside, at better rates, every single month. Walt's loss was loud and immediate. His recovery is quiet and automatic, and he never has to lift a finger for it. Now turn on Ed. Ed avoided the paper loss. Real. And worth something. But look at what he locked himself into. He owns bonds paying about 0.5% while the world around him repriced to 4%. He is stuck there until 2028, holding an asset that feels safe precisely because it's frozen. Run that forward. Ed's 500,000, growing at the rate he locked in, reaches roughly 516,000 over 5 years. If that same money had been free to roll into the new 4% bonds, the ones Walt's fund was busy buying, it would have grown to around 614,000. Ed's safety cost him close to $98,000 in income he simply never earned. His principal was never at risk. His opportunity was gutted. So the date solved one problem and created another. Holding to maturity protects you from price. It does nothing for the fact that you're chained to whatever rate you locked in, however bad it later looks. And individual bonds carry a risk the fund quietly diversifies away. Ed is exposed to whoever issued his bonds. With the US Treasury, that risk is close to nothing. With a single company's bonds, it is very much not nothing, and a fund holding thousands of issuers is the thing that saves you there, the opposite of a weakness. The honest version isn't Ed beat Walt, it's that a maturity date is a tool, not a trophy. It matches an asset to a moment, money you'll need on a knowable day. Use it there and it's close to magic. Use it as a blanket rule, and you'll trade a price loss you could have waited out for an income loss you can't get back. So the useful question was, never are bonds safe? That question has no answer, because it's missing the only variable that matters. The real question, the one Ed and Walt were unknowingly answering the day they bought, is this. Does this money have a date I'll need it, and does the thing I bought have a date that matches? Line those two dates up, and you've turned the whole problem off. Money you know you'll need on a knowable day. A tuition bill in 2028, a home purchase, a specific year of retirement spending, pairs with an instrument that has its own date, an individual bond, or one of the newer funds built to mature in a target year. The price can lurch around all it wants in between. You're not selling in between. You're waiting for the date, and the date pays you whole. That's Ed's magic, used where it actually belongs. Money with no fixed claim on it, a long horizon, an open-ended someday, is where a regular bond fund earns its place. No maturity, but no need for one, plus diversification across thousands of issuers and the quiet self-repair of buying fresh bonds at whatever rates the future brings. The only thing you owe that choice is honesty about its duration, how hard it'll swing when rates move. So a bad year is something you expected, not something that ambushes you. And this reframes the wreck almost everyone actually lived through. The classic 60-40 portfolio, 60% stocks, 40% bonds, the sensible default, fell about 16% in 2022. The bond half was supposed to be the airbag. It didn't fire because the thing that caused the crash was rising rates, and rising rates hammer stocks and bonds at the same time. The S&P fell 18% that year, and bonds fell right alongside it. The hedge broke for the same reason Walt's statement bled. The safe money was full of instruments with no date to hold to, being marked to a market that was falling underneath them. It wasn't that bonds failed, it's that most people were holding the dateless kind, in a year that punished exactly that. Here's everything you now know, small enough to run on your own account in about 30 seconds. First, pull up any bond fund you own and find one number on the fact sheet. Duration. If it's under about 6, it moves gently. If it's above 7, it moves for real. Treat it as a genuine risk, not a savings account. And if it's above 15, understand that you're holding something that will behave like a stock the next time rates jump, no matter what it's called. Most people who own that number have never once looked at it. Now, you're not most people. Second, go pot by pot through your money and ask one question of each. Does this have a date? Money you'll need on a specific, knowable day belongs in something that also has a date. A bond you can hold to maturity, so the price in between is just noise you get to ignore. Money with no deadline can sit in a fund as long as its duration is one you can stomach through a bad year. Third, stop asking whether the safe part is safe and start asking whether it's matched. Safe and matched are not the same word. 2022 was the entire lesson. Because here's what the whole thing comes down to. Two men bought the exact same safety. Same 500,000, same treasuries, same crash, the same loss on paper to the dollar. What split them wasn't luck. And it wasn't the market. It was a single date. One of them had a day his money came home whole. The other bought something that never has that day and never will. Everything else about them was identical. That one detail was the difference between losing nothing and losing $65,000 in the year the safest asset on Earth had its worst run since 1754. If you want to run this on your own holdings, your real duration, your real exposure, which of your pots have a date and which are quietly dateless, I built the calculator that does exactly that. You put in what you own and it shows you in dollars how much a rate move costs each piece and where a maturity date would change the answer. It's in the Wealth Logician's Vault, alongside every other tool we build for these breakdowns. The link's in the description. Hit like if this changed how you see the words "the safe part." Subscribe if you want to do the math on the next one. The bond market never sends you an invoice. Now you know how to read the bill anyway.